good on your end as well. And we'll go ahead and get started. Awesome, guys. Okay, so we're talking about dividend investing demystified. And I find dividend investing is a fantastic strategy for retirees, but it's often a misunderstood strategy. And there's a ton of marketing hype behind it, and it doesn't always live up to that hype, okay? And so actually, let me just make sure I'm recording this too, just in case. Sorry, guys, one sec. Perfect. Okay, awesome. Thanks for letting me know, John. So yeah, we're going to be talking about dividend investing, breaking down this popular strategy to determine if it's right for you. So on this agenda today, we're going to be talking about the very basics. What is a dividend and why is it so popular as an investment strategy for retirees? We're going to be talking about dividend taxation. We need to be looking at every investment through this taxation lens first. And then finally, where you should invest in dividends and where you shouldn't. So what type of accounts should you hold dividends in if you choose to invest in dividends? Okay, and so invariably, I'm sure a lot of you have seen these type of articles, these type of headlines, how to retire on dividends before the age of 40. Yes, you can retire on dividends by Barron's. How to retire on dividends, earn a safe 8% yield, leave your principal intact. And obviously these sound like dividend investing is the holy grail, the golden goose, if you will, of retirement. And so we're going to be talking again, if really they live up to this hype, okay? So again, from the most basic standpoint, what is a dividend? Okay, let's say we take a hypothetical company ABC, and let's say they own a chain of grocery stores. So obviously they're buying product, they're selling that product at a markup, taking in revenue after paying all their bills. Hopefully they have a profit. Okay, well, if this company is listed, on the stock exchanges, every person that owns a share, we have to always remember they own a share of that company. So they are a shareholder, a stockholder of that company. Now, if hypothetically one shareholder acquired 51% of the shares, they would effectively own and control that company. So we always need to remember what a stock is. A stock is a true ownership in a company. If you own a stock, a share of Amazon, you own a portion of Amazon. Okay, so as company ABC makes profits, okay, they take a portion of their profits and pay it to investors. This is a dividend, okay? So it's a portion of profits that they're then transferring to their investors, okay? And there's a couple things that you can do with a dividend, okay? So first, let's go with kind of, just make sure I'm still chugging away here. One sec, everyone. Okay, yeah, we're still good. Okay, just making sure. So let's go through an example of this. Let's say that you own 500 shares of ABC, okay, and the ABC stock price is $100. So 500 shares times $100, you have $50,000 invested in ABC Corporation. Now, ABC, let's say, decides to pay a 2% dividend. So what happens when they pay a 2% dividend? And this is where I see a ton of people getting mixed up. Okay, so for some of you, this is going to be review for some and kind of a no-brainer. For others, this is going to be eye-opening. Okay, when ABC decides to pay a dividend, oftentimes I see investors misinterpreting a dividend as if a dividend is an extra return on top of this stock's growth. So let's say at the beginning of this year, ABC was priced at $100. Let's say at the end of the year, it was priced at $100 as well. Most people misinterpret a dividend as if a dividend is a 2% add-on. So that stock price went nowhere. It had 0% growth, but they think that dividend grew their money by 2%. It's an extra 2% kicker, if you will. That is not how a dividend works. Okay, here's how a dividend works. In this example, when a dividend is given out, this share price goes from $100 to $98. Why from 100 to 98? Well, that's 2%. Okay, that's 2% of $100. So if we just think about it, if a company is holding profits, okay, and they decide to give profits out, that decreases the value of the company. Okay, said in a more simplistic manner, let's say you have $100 in your wallet. Okay, if you decide to give $2 out, your wallet is now worth $98. Okay. So the same thing happens with a dividend. We need to make sure we're not misconstruing what a dividend is. Share price goes from 100 down to 98, and you receive, depending on which account, a taxable $2 per share dividend. Okay. So again, this is what a dividend is. And you have two things you can do with that dividend. Okay. You can take the dividend as income. So at $2 a share, 500 shares, that would be $1,000. So you can take that $1,000 as income, or you can choose to reinvest that $1,000 now at the $98 per share cost. Okay. So if you do that, again, well, actually, I have the math on the next screen. So the math of the dividend in this example would be you have a starting investment of $50,000. That's pretty simply 500 shares of $100. Okay. Company pays out a 2% dividend. You now have, before you choose to take it as income or reinvest it, you now have a $49,000 stock holding, which is 500 shares at $98, and you have a $1,000 dividend. Okay, now if you reinvest that dividend, you'll have something like 510 shares of a $98 stock, and so you have $50,000. So if you were to reinvest that dividend, nothing changes. The dividend doesn't change anything. Okay, it simply is essentially a forced payout, if you will. Okay, which doesn't mean it's bad necessarily, but it's also not this magical thing on top of a stock that adds extra growth that a non-dividend stock doesn't have. Okay, and so oftentimes then, after explaining these examples, so how is a 2%? We get a question like, how is a 2% dividend any different from selling 2% of your stock holding? And from a pure mathematical standpoint, there is no difference. Now, there's some different inner workings that obviously a big reason why people like dividends is because in order to pay out a dividend, that company has to be making a profit. And so it's an interesting screen for owning companies that are paying out a profit. For instance, if you're owning a dividend stock, you know that company has a profit. Okay, you're not speculating, you're owning a company that, again, has a profit. Okay, so what are some of the benefits of dividend investing? Okay, few of the benefits are, number one reason I think dividend investing is most attractive is what we just talked about. You're investing in a company that you know turns a profit. So generally speaking, this means a more stable investment. Okay, because again, let's say we're investing in a startup that is losing money each year, a brand new IPO that's not turning a profit versus a stable company that's turning a profit, it's reasonable to expect that, sure, that startup has a little bit more upside, but from a stability standpoint, obviously a stable company turning a profit should be a more stable investment. The other big benefit, where I think in terms of looking at other ways to invest for income, is that the income can grow through time. And I think this is one of the most attractive parts of dividend investing. Okay. Generally speaking, dividends are stable through time. So even when share prices fall, typically the dividend yield goes up, thus keeping a similar overall dividend. And then historically, they've been very tax preference. Okay. So I will say in the past, dividend investing has been even more powerful than it is now. Today, there's not a huge tax preference in investing in dividends. So let's try to examine a few of these, okay? Let's go through a bond first. And when we talk about income investing, and I know Tony debunked a lot of the whole idea between income and growth investing last week, but let's look at what most people consider income investing and let's compare it to a dividend, okay? So a bond, okay, 2% yield. Let's imagine you're holding these bonds to maturity. So there's no interest rate risk. Holding to maturity, there isn't any interest rate risk. So let's say you have a $1 million principal retirement account and you're investing in this 2% bond. Okay, well, again, 2% yield, simple math, $20,000 coming from that bond. Now, the thing about bonds and why we're often so critical of them, even if you're holding them to maturity, is that there's no inflation protection, if you will. Okay, you're getting that, there's no growth of income, which means you're susceptible to inflation. So that income in year one, it's going to look the same as in year 20. If you're investing that principal and you're earning the same yield and you're spending that yield as income, your account's not going to go anywhere. Yes, you are gaining income throughout that time, but that income is becoming less and less valuable because of inflation. Versus, let's look at a high dividend ETF. And I will say I'm being very fairly conservative on the yield side. There's numerous, as I was putting this presentation together, there's numerous dividend ETFs with a higher yield. Let's say you have a 3.5% yield and we can expect some 6% growth from this stable company. Okay, so you're essentially getting two benefits. You're still getting that income, but you're also getting that growth, if you will. So again, that yield still is coming out of that growth, because remember, the dividend lowers the share price. But nonetheless, we can see through it move through time, and it's a starkly different situation. Year one, 6% growth, taking out that dividend, you get $35,000 of income, and your principal is $1,022,000. By the time we get to year 20, notice the principal's grown to $1.5 million, and look at where the income's grown as well. Again, because you're getting both parts of that. So your yield, in a way, is growing through time as well if you're keeping that 3.5% yield, because it's also receiving a 6% growth, again, minus the dividend on top of that. So notice what happens with principal and income. It adjusts better to inflation, okay? Now, granted, this is a very simplistic example, because the trade-off with a dividend ETF is that you're investing in stocks. And we know stocks can have more volatility. So we know in reality that 6% growth might play out over time as an average, but there might be years where that dividend stock still loses 20, 30%. And so that's going to, again, add some volatility to the situation. Now, that being said, again, generally dividends are stable, so the income should stay fairly similar. And if we just look at a dividend index versus the S&P 500, okay, just looking at the difference in holdings, what you'll notice is the dividend index holds generally more stable industries. Okay, and let me just get my my writing tool out here. So, for instance, you'll notice technology is the #1 holding in the S&P 500 right now, and it's much further down the list over here on the dividend side. Things that are generally thought of as more of defensive industries that in a 2008 type environment we expect won't lose as much. Utilities and real estate obviously was more focused on 2008 was more focused on the real estate industry, but generally real estate is thought to be more stable. Notice that these are much higher in a dividend index. So it's almost as if there's an inverse here. You can see financials are kind of one that breaks the mold, but we see energy again, lower in the S&P 500, higher in the dividend index. So in general, dividend companies are, again, more stable, more defensive industries, okay? So when we're thinking about investing in dividends, how should we assess a dividend stock? How can we assess if one stock's better than the other? What should we be looking for? Okay, so I have two hypothetical examples: dividend stock ABC and dividend stock XYZ. Okay, and because dividend investing has gotten a lot of marketing hype behind it, I find that a lot of people are just looking solely at the yield. And I'll tell you, that's the exact wrong thing to be looking at when you're assessing a dividend stock. Okay, yes, the yield matters, but it should be further down the list for how you're rating a company. For instance, let's say we have dividend stock ABC. It has a 6% yield. And let's just say the company's strength is poor and the growth outlook is poor. Remember, there are two parts to investing in a dividend stock. You have the growth and then you have the yield. Well, the growth, the stability of the company, the general growth outlook is more important than the yield. Okay, so even though dividend stock ABC has twice the yield of XYZ, XYZ is a stronger company, is a better growth outlook, okay, has a better growth outlook. So even though it has half the yield, it will likely play out in a lot better way over time, because again, that yield is coming from the price of the stock. Okay, so let's say, completely hypothetical, this would be impossible to happen, but let's say there's a stock with 100% yield. Well, essentially that would mean that they're giving the share of the price, they're distributing it to shareholders, and there's no company after that. So a yield doesn't necessarily mean better. Okay, we care much more about the growth and general outlook of the company. And we'll talk through some examples why. So hypothetically, which dividend investment is better? It'd be investment XYZ, okay? And again, when we compare dividend investing to other indexes, on the screen right now, I have the Vanguard Dividend ETF. That would be the red line here. I have the S&P 500 ETF, which would be the blue line here. And then I have the S&P 500 Growth ETF, which would be the yellow line here. And if we look down here towards the bottom, let's see if I can just get this off the screen. Oh, I want you. It looks like that's going to stay on the screen. Well, we notice that in general, the dividend ETF will have a slightly lower growth rate, but will have also a slightly lower volatility on average, and will have a more stable, worse year as well. Growth stock, for instance, your trade-off is higher growth, higher volatility, a little bit higher of a drawdown. And obviously the S&P 500 includes dividend stocks, value stocks, and growth stocks. So it'll be more of just a general benchmark and mix. And so when we look at this idea of dividend stocks being more stable, that is a benefit, to dividend investing. And it makes sense. It's a company that turns a profit. So when you're screening based on that, that should be the case. Now notice, for the majority of the time, this dividend ETF and the S&P 500 did about the same. Now, here's what you'll often see when people are marketing dividend investing, is that you don't just willy-nilly hold all dividend companies. You screen for certain added benefits. So for instance, here we have a bunch of different screenings down here, and you'll notice the best performer versus the worst performer. The best performer was dividend growers and initiators. Basically what that means is if you have a dividend and you're growing that dividend yield through time, that's in this example generally a good thing. If you don't have a dividend and you initiate a dividend, once again based on this screening, that would be a good thing. The opposite is true for dividend cutters or eliminators. Okay, so you can see dividend cutters and eliminators down here, and dividend growers and initiators up here. So that's generally the argument when just holding a dividend index, is you're better off screening for certain metrics on the dividend front. Now, that being said, don't go out and simply start investing in dividend growers and initiators. Well, why would that be? Well, because this chart, these type of analyses were made in hindsight, meaning they were probably made around 2010. Okay, they weren't, this research, this stuff wasn't put out in 1972 saying this is what we expect going forward. So it's a little bit of data mined, if you will, meaning that it's looking back into the past and saying this would have been the best in the past. Well, that we know that doesn't always play out going forward in the future. And also notice that the majority of growth here, I wish this was on more of a what's called a logarithmic chart. The majority of the growth in this type of dividend investing happened between 1972 and 2000. Notice since then, we saw a point where dividend growers and initiators was quite a bit higher and came down significantly more than just all dividend paying stocks. So again, leads to a little bit of data mining. Be cautious moving forward with looking at these type of graphs and changing your whole investment strategy going forward based on that. So let's talk through some drawbacks of dividend investing. So dividend investing, again, because we're assuming we're getting a little bit more safety because it's a more stable company, we have to give something up. Now, typically, historically, dividend companies have underperformed in a growth sense. And again, this makes sense. More stable company, on average, less upside. Here's my biggest concern around dividend investing is that there is lacking true safety. Okay, so there's still a huge risk of loss, and we'll walk through some examples of what that means. The other big issue on the tax planning front is a dividend is basically a forced withdrawal. Okay, so one, obviously in a taxable account, you're being forced to pay taxes on that dividend each year, whether you want that dividend or not. So let's say before you were retired, you had a taxable account, you were investing in dividends, dividend growing stocks. dividend, they paid out a dividend. Well, it was forcing you to pay income in those years, or pay tax in those years that you received the dividend. Okay. So basically it's forcing you to take withdrawals not on your timeline, typically causing you to owe more in taxes. And again, we'll talk through a little bit how to manage that tax situation a little bit better. The other thing, however, though, is from a pure company management standpoint, from a strategic growth standpoint, I think dividends are a questionable strategy. Okay, and we'll actually hit on this topic first. And I'm not the only one that thinks this. Arguably one of the best investors in the world, Warren Buffett, agrees in the same way. So in a recent annual letter to Berkshire shareholders, he notes that a company can do 4 things with its profit. So a company has a profit, it can do one of 4 things. It can reinvest in the company. Okay, so let's take Safeguard Wealth Management. Okay, we're a company. We turn a profit in a given year. We can do a couple of things with it. We can reinvest that money, upgrade our technology. We can put it towards marketing and in order to try to grow our company and whatnot. Okay, number 2, we can acquire other companies. So we turn a profit. We could go buy a CPA, okay, and add tax planning in-house. We could buy another financial services company and try to grow our company through acquisition. Okay. Number 3, we're not going to cover this. Would probably be a whole presentation. And again, a very misunderstood topic: repurchasing shares. So basically, there's so many shares out there. They can start repurchasing shares and basically, do a lot of different things on that. We'll do another whole presentation on that. But number 4, they can pay a dividend out. So again, in our company, that would be paying a dividend out to owners. That would be Tony and I. And so when we think about this from a strategic management standpoint, I think it also says a lot that a company pays a dividend, because you're basically in a way saying that I would rather pay dividends out to my investors because I don't have better strategies in order to reinvest in the company and grow it. I don't have any ability to acquire other companies with that cash. And I don't want to repurchase shares. So my check down is giving it to investors. Okay, which isn't the worst thing in the world, but it also speaks to not having other opportunities to grow that company, which from a strategic management standpoint, it worries me a little bit. And again, Warren Buffett agrees with the same. Now, that being said, Berkshire Hathaway has never paid out a dividend. So from a strategic management standpoint, Warren Buffett has had better ideas for reinvesting, acquiring other companies, and repurchasing shares. But he's invested in a lot of companies like Coca-Cola that pay a dividend. Okay, so he goes on with this. Buffett notes there are 2 disadvantages with paying out a dividend. 1, dividend investors may have different levels of payouts, okay, which makes sense. 2 retirees, one needs a 2% withdrawal from their asset, the other needs a 4% withdrawal. Well, if they're investing in a dividend stock that pays a 3% dividend, it's not really meeting either investor's expectations. Also, the dividend is received as income, which if you're a long-term investor that doesn't need the income, you don't want that because you have to pay taxes on that. And so Buffett lays out a similar strategy that I would offer, which is for those who want a dividend, shareholders can effectively generate a dividend type wealth by just selling shares. So again, you have 500 shares of $100 stock. If you want $1,000 out, sell 10 shares. It's the equivalent to receiving that 2% dividend, but it happens on your timeline. Okay. And so the biggest misunderstanding that I see is, in general, dividend investing should lead to more stable companies, but that doesn't mean it's a rule or a law of nature or anything like that. So dividend investing doesn't always equal safety, and how the investment performs from a growth loss standpoint, again, I argue is more important. So we have GE on the screen. Used to be one of the biggest companies in the world, but has since fallen significantly, lost 60 to 75% of its value. So back in the early 2000s, we saw it was up here at a little bit over a $30 per share price, and we've seen it go down since. And so what happened if you were an investor? Yes, you received a dividend the whole time, and as this GE lost money, your dividend went up, keeping your general dividend about the same because the yield went up as it was losing money. However, your investment, if you invested $1 million, you lost either way, whether there was a dividend or not, you lost 60 to 75% of your wealth. So the growth matters more. The potential loss matters more. Again, we have international papers, and just so you know, I am cherry picking some of these investments, but that's kind of the whole point. Dividend investing, the safety for dividend investing, again, isn't some law of nature. We see international papers at one point was about $30 a share. In 2008, went down to, looks like about $5 a share. And the dividend went up throughout this time period. But again, that didn't matter because you lost a significant amount of wealth, whether they were paying a dividend or not. Remember, the dividend is still coming out of your share price. So it's a forced withdrawal. So if we put it in a different context, at the bottom of 2008, as your investment, let's say just your general investment lost 50% of its value, do you want to be forced to take a withdrawal? Well, if you reinvest it doesn't matter. But if you don't, then it's the equivalent of you taking income at that point. Generally not a great idea. We have AT&T from the early 2000s. We see once again, lost a significant amount of money. Sorry for my arrow there. Dividend yield went up, but again, it didn't matter. Not to beat a dead horse, Citigroup, $450 about at a high for its share value, now down to about 34. So it lost, 90% of its value. Dividend went up. That's great, but it doesn't matter because you lost the majority of your investment, if you will. So again, just because they have a dividend doesn't mean that it's a safe investment. Here's a list of companies that went bankrupt that paid a dividend. You'll likely know some of them on here. Enron, WorldCom, Lehman Brothers, all notably paid a dividend or currently bankrupt. Other companies filed for bankruptcy and have restructured. Okay, both paid a dividend. You see there's other companies in here as well, paid a dividend, but yet still went out of business. So whether it paid a dividend or not, you lost the majority of your money invested in these type of companies. So dividend investing, once again, does not equal safety. Okay. And here's, again, where I see a bigger drawback for dividend investing. On the screen right now, I have the S&P 500 from 1994 to 2015. And you'll notice through this early 2000 decade, we saw two significant crashes here and here and here. And so let's say you had all of your money, all your retirement money in the stock market. We talk about this often. Where would you ideally want to make withdrawals? Okay, you want to make withdrawals through these green periods here. Whoops. Okay, why? Well, because you want to generally sell investments when they're doing the best. You don't want to sell them as they're going down, because it's basically reverse dollar cost averaging. So if we lost 50% during the tech bubble, if you were taking withdrawals through that period, you might have lost more like 60%. Okay. And so now recovering back, you aren't going to recover back as strongly as you would have if you wouldn't have taken those withdrawals. Well, this is a general issue with dividends, is it's forcing you to take withdrawals at times that you might not want to. Okay. And sure, you can reinvest those dividends and have the same, be in the same spot. But nonetheless, when we're talking about an income investing strategy, assuming that you're going to always take income, it's forcing you to take withdrawals at non-optimal times. You'd rather that money stay invested, recover, and again, take those withdrawals as that investment's recovered. So taxation of dividends. This has changed through time. Okay. Dividends were extremely valuable from 1913 to 36 and 1939 to 1953 because they were exempt from income, exempt from tax. Okay, so during those periods, a forced withdrawal when you don't owe any taxes, I mean, we have zero issues with that. Dividend investing becomes uber valuable through those time periods. But notice there's also been times where they've been taxed at basically normal income rates. Okay, well then dividend investing becomes less valuable during those times. And right now we sit where this isn't really correct. It's basically taxed at long-term capital gains rates. So for a married couple here, we see up to $80,000 of taxable income. You don't owe any tax on. You won't owe any tax on your qualified dividends. Obviously 80,000 to almost 500 would be 15%, and over that would be 20%. And just know you'll also have an Obamacare surtax on that 3.8% added expense as well. So right now, the taxation of dividends isn't a plus or a minus. If you're holding a dividend in a taxable account, you're basically going to be taxed whether you take a dividend or whether you decide to sell a portion of that stock. You'll be taxed at the same rates. Okay, so their taxation right now is kind of an equalizer, no adding, no drawbacks. But it's important if you are investing in dividend stocks to hold them in the right way because it's forced withdrawals. If you want to reinvest those stocks or reinvest those dividends back into the stock and not be taxed on it, you have to hold it in the right account. So holding them in tax deferred and tax free accounts. Why? Because the dividend won't create a taxable event. Holding it in your taxable account, every time you receive a dividend, it gets added to your taxable income in that given year. Especially in retirement, that's a big no-no. Okay, because imagine you have a big taxable account, you're investing in dividend stocks, but you're trying to control your income for Obamacare in order to qualify for a subsidy for Obamacare. Well, if those dividends force you to take too much income, okay, you're going to lose that subsidy that can cost you a lot more than any dividend could have gained you. So holding them in the right accounts, and just to review a few taxable account rules. Again, this is designed so that you're not paying taxes on someone else's timeline. You're paying taxes on your timeline. Okay, paying taxes when it makes the most sense for you. So 4 taxable account rules: don't hold mutual funds, don't hold bonds and fixed interest investments, don't reinvest dividends if you have dividends, because again, you want that as cash that you can deploy in whatever way makes the most sense. And then don't hold high dividend stocks. Each of these for the sole reason of if you're invested in these, let's say you don't control the taxable income that comes from that account. Okay, and you want to be in control, put simply. Okay, so let me know if this is making sense. Again, I think dividends are fantastic. I think it's a fantastic way to invest, but they're not some magical extra return that you receive. Okay, so in summary, it's important to not buy into all of the marketing hype around dividends and look at what dividends are for what they are. Okay, and always be thinking about tax first when investing in dividends. Okay, and again, be thinking about tax first regardless of what decisions you're making in retirement. So just see if we have any questions here. I'm not seeing any yet. Feel free to post if you have any questions. Always remember, you don't need more money. You need a better plan. Thanks for watching. If you're watching this after the fact on YouTube, make sure you hit the subscribe button. Be notified of all future videos that we put out. Thanks for watching. Have a great rest of the day, everyone.